One of the most popular goals for an investor is the opportunity to create a passive income stream. Because you have access to money without having to constantly work for it, or you only have to do minimal work to get passive income, it's definitely one of the most helpful things in terms of wealth building. So when you talk about passive income, what comes to mind? Well, today we have two examples of passive income streams that have been tried, tested, and work well for beginner investors. This is Intelligentsia, real life advice for practical and financial goals. Today, we want to talk about index funds, real estate investments, their differences, and who they benefit from. So let's get to it. Let's talk about index funds first. An index fund is a mutual fund or exchange-traded fund or ETF that attempts to replicate the performance of a specific market index, such as the S&P 500. This lets you have better returns over time if you're someone that expects the overall economy to perform well. The fund invests in a diverse portfolio of assets that reflect the composition of the selected index. Since you're investing in a broad range of companies, you're diversified and thus the risk you take is greatly reduced. Your assets are also highly liquid and can be bought and sold on the market during trading hours. This ensures that you have readily available assets for sale, and it can act as somewhat of a backup for your emergency fund should the need arise. If you're not an active trader, index funds also help you out as they have lower management fees as opposed to actively managed stocks. You have to understand that since the maintenance requirement is lower, the fees are also reflective of that price. This allows you to pay less for a passively managed fund. However, it limits you to only the market's performance instead of actively trying to outperform the market. There's lower risk and volatility involved because you're essentially just copying off the market, and historically, they've been able to provide competitive returns as opposed to individual stocks. Since the fund follows a fixed list of companies and index, you don't have to worry about picking stocks and changing your mind. You just hold onto your portfolio for the long haul and enjoy the mix of companies over time. Remember, the key idea is that an index fund is a simple, convenient way to own a little piece of a big mix of investments without stressing too much about picking the perfect ones. It's like getting a taste of the whole candy store without having to choose each candy individually. Now, for beginner investors, this is attractive because you don't have to deal with studying the market and trying to maximize your money off it. You can let your money grow over time through capital gains, or you can have it earn you dividends over time. Either way, index funds allow you a reliable way to earn money passively. Now that we've talked briefly about index funds, now we want to talk about real estate investing and how it works for you. It shares some key similarities with index funds in terms of passive income and having your assets grow in worth over time. Regardless of whether you go traditional or you prefer real estate investment trusts or REITs, the end goal of having passive income is the same. Now, to explain further, purchasing and holding physical properties such as residential, commercial, or industrial real estate, or investing in REITs are examples of real estate investments. Real estate is a tangible asset that allows you to earn income through rent, and if you're someone that's more comfortable with owning physical property, then the traditional route would lean more towards your preference. If you invest in REITs, you also have the benefit of having a more diverse selection. This is achieved by investing in different types of properties like residential, commercial, or geographically diverse locations. Compared to index funds, real estate investments require more long-term holding and they're less liquid than stocks. This means that if you need quick cash, then real estate investment might not be for you. Adding on to what real estate investments need, they also require active management, upkeep, and dealing with property-related difficulties, all of which can take time, effort, and extra money. Just like owning a car or a pet, owning property comes with costs. You'll need to take care of the property, pay for repairs, and cover other expenses like property taxes and insurance. For the purposes of wealth building, however, real estate investments offer one of the most consistent ways to grow your money over time. Other than that, if you're someone starting out, you can leverage it through mortgages. That way, you're allowed to control a larger asset within a smaller initial investment, helping you get your start the right way. Sometimes, you might not have all the money to buy a property. You can get a loan or mortgage from a bank and pay it back gradually while earning money from the property. But if there's one single most important thing that real estate has over others, is that land is finite and the price in real estate can only go up over time. Historically, it has provided a relatively stable return with potential for income from rent and capital appreciation. Location matters. Properties in popular or growing areas tend to be more valuable. Do your homework and understand the costs and potential earnings before buying. Remember, investing in real estate is like planting a tree. It takes time to grow, and if you take good care of it, it can provide fruit and profits for a long time. That said, there are some key differences based on the points we provided. 1. Nature of investment. Investing in index funds means you're buying pieces of many companies or assets all at once. You're essentially buying a mixed bag of companies and you have access to everyone. For real estate investments, investing in real estate means buying a property or a share in a group of properties. Now for diversification. Index funds give you a lot of diversification because they allow you to have access to many different companies or assets. You have a variety of companies in your portfolio. As for real estate investments, while owning multiple properties can diversify your real estate portfolio, it might not be as diversified as an index fund. Each property is different and has many things going for them. As for liquidity, index funds are highly liquid, meaning you can trade your stocks easily in the market during market hours. This means you can acquire and get rid of them easily if you feel the need to make changes. Real estate is less liquid because selling a property takes time and effort, like finding a buyer for a house. As for initial investment, you can start investing in index funds with a relatively small amount of money, and most of the time, you don't even have to pay much in terms of maintenance fees. But for real estate investments, buying a property usually requires a large amount of money up front and thus becomes difficult for beginner investors who aren't as aware of certain leverages that they can utilize, like FHA loans. For ownership and tangibility, for index funds, you own shares in a fund which aren't tangible and are online, as opposed to real estate investments which are owned physically. Here, you physically own a property or own shares in a property-owning company, like owning a house or a share of a house. Regardless of which option you choose, you have physical proof of where your investment was placed. Now for maintenance and management. While index funds are passively managed because of their nature to replicate the market, you don't have to pay attention to it all that much. However, there are the natures of fees in question when it comes to management costs. As for real estate investments, since it's a physically owned asset, there may be some times where you'll need to invest more money into repairs, maintenance fees, and other things that require you to protect your investments. If you've invested in REITs instead, they still need to be paid their management costs, and that needs to be factored in too. Now for potential returns, you're essentially limited in index funds to how the economy performs because the fund replicates the market. As for real estate investments, provided that you have a steady stream of tenants, income is secure and you can make more over time. That said, it's not as stable as index funds if you don't have the proper location, clientele, and positive economic factors. Overall, index funds offer more diversification, liquidity, and access to beginner investors, while real estate offers tangible ownership, rental income, and long-term value appreciation. While that's the case, understand that investors aren't limited to only index funds or real estate and can offer both if it's manageable enough. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy and let's get financially fit together.